Hello sector watchers, welcome to the show. This is the 101st episode of Sector Spotlight on Tuesday the 19th of October, recording it on Monday the 18th. My name is Julius the Kempenaer and I'm presenting to you from Amsterdam in the Netherlands. If you want to connect with me, please use any of the handles on the screen. I love to have a discussion. If you haven't seen the 100th episode of Sector Spotlight that was aired last week, please do so, because I had Tom Dorsey as my guest and I think we had a very interesting discussion and a very interesting chat. We got quite some good feedback. Everybody loved it. You know, you cannot not love Tommy. So if you're interested in point of failure relative strength, if you're interested to hear what he's got to say, please check back and look at that 100th episode. For this week, we're going to do a very quick look at sector rotation. I'm going to skip asset classes. I'm going to do a very quick check on current sector rotation. And then I'm going to talk about a cluster of questions that came in via email. And they're all centered around the same theme, or same two themes, I would say. So I'm going to spend a lot of time on going over a couple of these things. And if a lot of people ask the same thing, then it's probably something that lives among viewers. So I think it's important to pay attention to that. And I'm going to spend some time to answer these questions for these people. But for now, let's have a quick look at sector rotation as it's happening last week and right now. A quick look at sector rotation as it stands right now and what we've seen last week. Right hand side, daily RRG, left hand side, the weekly version. We have a quick look at the 6-day performance, so it includes today, Monday. Consumer discretionary at the top with a very nice gain of 4.8%, followed by real estate at 3.7%, materials 3.6%, and technology 3.5%. Then the index comes in at 2.1%, and everything else has been underperforming the S&P 500 over the last 6 days. That includes energy and financials, both tails that are really strong on the weekly RRG, so they're in, on good rotations. Maybe not, well, what's striking now, or what is catching the eye, is the leaning towards the more offensive sectors. I just wrote an article over the weekend saying that sector rotation is still confusing. But I do think that we have seen, including today, there's a change seems to be going on. I'm not 100% convinced yet, but it looks as if we have a change going on. Look at the rotation here. So we've got staples, utilities, healthcare, communication services, not so much. But these are all considered to be defensive sectors, and they're all underperforming. And if you look at the weekly rotations, then you see the same popping up at the bottom of the list. What do we see at the top here on the longer term trends? We see financials, discretionary, energy, and at the shorter term we see discretionary, financials not so much, energy not so much. But what popped is the consumer discretionary sector, because the ratio between discretionary and staples is a ratio that can very well be used for offense versus defense. And on the RRG, you can see that, and I'm gonna create here XLY, XLP, so you can see what I mean, is that these tails are sort of moving in the same direction, which is what you usually don't see, because they usually move in opposite directions. Now, the last lag here is only of Monday, so that will be fluid for the rest of the week. But if you see the difference only for one day, look at the dot for staples. It almost didn't move, where discretionary immediately started the week off with a strong move into a strong RRG heading. So that is, it looks as if that discretionary sector is now starting to pull away from staples, and that shows up even better in the on the daily RRG, where you see that XLY is turning back up. It was in the weakening quadrant, and it's now turning back up towards leading, and we know that that is usually a strong sign in general. If you look at the tail of staples, that's doing the opposite. So here we see that discretionary and staples are actually moving in opposite directions again. And let me magnify that for you. So we've got the two here, and they do exactly what we usually expect them to do, and that is rotate in opposite directions. And it looks as if the discretionary sector is now actually pulling away as well as on the weekly. So that's a early signal for an improvement of offense over defense. And it becomes quite clear when you look at the direct relationship between discretionary and staples, and it's breaking above almost, well, it's the range of the year. So this ratio traded between 2.4 and 2.65 for the entire year, and we're now breaking away from that broad range, which is if you look at it like this, a pretty strong signal in favor of offensive sectors. Now, if we look at the chart of SPY, we're not there yet because we do have this high in place and we broke below that trend channel. However, there are things that are starting to improve on the SPY chart. For one, we are taking out the previous high here. So this is a daily chart of SPY. So we're taking out that 444.89. We closed at 447 today. So a little bit of follow through. The crucial number to watch here, I think, is 4526. That's the previous high. If we go above that, S&P is back in the uptrend, if it's not already. And what my eye just caught is the green lines that I marked here. And the question mark is, did the S&P just execute a falling wedge, which is a bullish pattern? We've got to wait and see. If we take out 4526, that's a strong positive signal. Under the hood, offense seems to be picking up versus defense. That's a good thing. So I think it's about time that we start shifting from watching risks on the downside to new opportunities to the upside. Over the last few weeks, 2-3 weeks, I got a number of questions in the mailbag that I have grouped together because they all sort of center around the same theme or two themes. So let's first have a look at the questions that came in as they were written. Now, the first one is from Louis, and he writes, Julius, please take a look at the attached chart. I'm having trouble understanding the RRG indicator. The chart will explain my question, and I have problems with the underscores because Louis is using the unadjusted time series, but that's fine. So here's the chart. It's the EWCO, that's the Equal Weight Communication Services sector. RSP is the Equal Weight S&P 500. Here is the ratio between the two, and these are the RRG-Lines of EWCO and EWCO in relation with Equal Weight SPY. And what he's writing is, I'm confused by the RRG indicator. Look at the last 3 candles of EWCO. That are those 3 candles. It closed lower and lower. RSP has closed higher and higher, which are these ones. This is exactly what traditional relative strength indicator shows being turned down, breaking support. While this is happening, the RS ratio and RS momentum are rising. RS momentum above 100, this would be improving. I want to believe the RRG indicator, but it was always taught, trust but verify. It's hard to believe the RRG indicator when I don't really understand why the RRG is saying the sector is improving, while the traditional relative strength is showing a downwards move. Would you please clarify this for me? Yes, I will, Louis. But let's first go to the other questions, because as I said, they're all kind of related, so we can bring that all together and give you one or two explanations. So the second question comes from John, and he says S&P is at crosshairs. If the S&P is in an uptrend, returns are positive. If a sector stock has an RRG, it's on the right hand side or the center, its returns are greater than the S&P 500. It's outperforming the S&P 500 either by a lot or by a little. I'm perplexed why the RRG can't or shouldn't be used as a buy signal. David Keller, starts every show talking about his mentors teaching him to look at the chart of the S&P 500. At the end of the day, it seems the RRG would be an effective way to decide what to buy and when. If weekly RRG is in green and daily is also in green, the sector is outperforming the S&P 500, both long and short term, why not buy? What am I missing? I feel so lost. I would love to have a whole show by you guys addressing how to use the RRG for successful traders, both buying and selling, which is, by the way, a good idea. So I'll ping Dave Keller and see if we can do a special or a one-off. I'm sure he's down for that. Again, so this is, again, the same sort of problem as Louis had, not exactly understanding why the RRG lines or why the RRG indicator is doing what it's doing and how to. John's is more about responding to those moves. Now Malcolm comes in and says, thanks for RRG, I use it often. I use it to try and predict the future. Would it be best looking at the weekly or the daily graphs? For example, this weekend, 16th of October, XLE is at the top of improving in the weekly graph, but it's at the line dividing between leading and weakening. And I think there should be like on the daily graph. I guess I should be using daily graphs to predict next week. Thank you very much. That's also, I rank that as an interpretation question. And then the last one, the final one. Hi Julius, I trust all as well. My name is Stan, subscriber, I'm still learning. Question. JDKR's ratio, RRG versus price relative indicator. When using both side by side, I'm noticing that there is a significant difference between the two indicators. JDKR's ratio portion of the RRG relative strength indicator lags the price relative indicator, for example, symbol versus SPY. Seems to me that the algorithm for both should be the same, i.e. a simple ratio calculation, or is there more to it? And then the last question is, how do you split windows? Okay, the split windows is a Windows thing I'll show you in a minute. But the other one is also an explanation or a clarification on how the RRG lines are interacting with relative strength and with price. In order to best answer this cluster of questions and go a little bit more in depth, I think it's important to once more show the definition of an RRG, because I think that alone will already explain a few of the assumptions which are wrong in a number of these questions. So the definition of an RRG is that a relative rotation graph shows trends in relative strength or trends in performance of multiple securities in a universe against a common benchmark and against each other. Be careful, they do not show relative performance as such. Now, if we go back into the questions, let's take out a few of the assumptions and try to dissect them. So what Louis is doing here is looking at the last 3 bars. That is super short, and I don't think that makes up a trend. So he's actually using the RRG lines, which are trying to pick up trends in relative strength, to do something or say something over the last 3 candles. That is just too short. That is not the trend that RRG is trying to pick up. Doesn't matter whether you're using the daily or the weekly. And if we look at what RRG is trying to pick up, because Louis has that on his chart as well, that is the relationship between, in this case, the equal weight communication services sector and RSP. Now, you can see that this is a downtrend, or was a downtrend, maybe still is, depends a little bit on what your investment horizon is. And mind you, the RS ratio is the most important one. That's the measure, that's the metric that measures relative trends. The RS momentum is a secondary line that is measuring the rate of change in these trends. So very rough guide. When the RS ratio line is below 100, the relative trend is down. When the RS ratio line is above 100, the relative trend is up. The RS momentum line will give you some guidance whether that trend is still being powered higher by strong momentum or whether it's leveling off and rolling over, or on the downside, whether it's leveling off and curling back up. And that's what you see here. You see that that downtrend was picked up. Louis even puts in a dotted resistance line in relative strength, says it's breaking below previous lows, so basically suggesting that that downtrend is continuing. And in a sense, that's what RRG-Lines say, because the RS ratio line is still well below 100. And the reason why that RS momentum line is picking up is because of that flat move over these 2 months here. So after an initial decline, that relative strength of EWCO sort of flattened for a while. And that takes the downward momentum out of that downward trend. And that's why the RS momentum line has picked up and creeped above 100. We'll look at the chart, at the live chart later on, and maybe a little bit more clarification. So I think the basic message here is RRG-Lines looking at relative trends. That's pretty crucial, especially when you look at a chart like this. So we're trying to pick up trends in this relationship with, in this case, EWCO versus RSP. But on an RRG chart, we're putting them all together and comparing them all together and basically trying to make sense of the interaction. So this is a very basic relationship. On the RRG, we got a much more complex relationship. Now, here is the same. Here also that definition is crucial because John makes an assumption that is wrong. If the S&P is in an uptrend, the returns are positive. If sector divided by stock has an RRG that's on the right-hand side of the center, its returns are greater than the S&P 500. No. The relative trend of the sector versus the S&P 500 is upward. That is, it's a subtle difference, but it's an important difference because it's very well possible, as we may see later, that the returns over a specific period or part of a period, while the sector is on the right-hand side of the RRG, the returns may be lower because it's going through some sort of a hiccup or a consolidation, which is not, according to the RRG algorithm, affecting the relative trend that's underway. So be very careful with the assumption or saying that if the sector has an RRG that's on the right-hand side, the returns are greater than the S&P 500. Or if the other way around, if the returns are greater than the S&P 500, the sector should be on the right-hand side of the graph, because that's not necessarily either. It can be on the left-hand side, and you can see a little hiccup in a relative downtrend for, depending on, if you're looking at a daily or a weekly RRG, a couple of days or a couple of weeks, that's not going to affect the trend that's in play at that moment. Now, for the rest of the question that John says with the relationship to buying and selling signals, the reason why I think it's perfectly fine to use RRG to detect or narrow down buying and selling opportunities. The only thing that I'm always telling people is that I don't believe you should use it as a standalone system, because analyzing financial markets, looking at charts, etc., is basically a big puzzle of financial markets that we try to solve each day, and RRG is just one part of that puzzle, and I think it's an important part of that puzzle because I think RRG is the image on the front of the box. It's giving you the big picture, and from there on you can try to find the little pieces to put together that puzzle. So RRG will tell you where to look for various bits and pieces. Now, having said that, you can definitely come up with trading rules and building blocks and implementing RRG in a trading strategy. But there's no set of hard rules because there are so many different investors. And when people ask me what are the trading rules, what are the signals, or what is the track record, I always ask them, so what is the track record? What are your buy and sell signals for a bar chart? Because in essence, it's a chart. It's a chart type, and people with different investment horizons, different thoughts about the market, different markets, they're all looking in various ways. So, someone using a bar chart can trade 5-day breakouts. Someone else trades 20-day breakouts. Or, if you look at the RRG, somebody buys 50-day moving average when the price crosses above a 50-day moving average, and the other one buys when the price moves above a 5-day moving average. And I've given numerous examples of that on an RRG. So when you move from improving to leading, that's probably more towards the 50-day moving average or whatever it is. I mean, if you want to think in terms of moving averages. And crossing from from lagging to improving is more like the 5-day moving average. What I'm trying to say is, from improving from lagging to improving is a very aggressive way of using it, i.e. the 5-day moving average. And when moving from improving to leading is a much more conservative way of using it, i.e. the 50-day moving average or the 5-day breakout and the 20-day breakout. I assume you get the idea. So so with regard to this question, we're looking at trends, not necessarily correlated with the returns, or they're not the same as trends are not the same as the outright returns. And yes, there are definitely ways to use RRG for triggering buy and sell signals if you like. It's just, I think that you should put it into a bigger perspective and a bigger picture. But I know there are people who are actually running strategies based on RRG. As a matter of fact, we're doing it ourselves with the example that I gave you on the CMC market site in the UK. It's not really available for people in the US, but it's a completely quantitative way of using RRGs in a trading strategy. So I'm going to talk to Dave, and maybe we do a complete show on this because I think it would be fun as well. And then on this one here, RRG to predict the future. I don't like to predict the future, and I don't think RRG is a tool to predict the future. It gives you some guidance, but predicting the future is kind of, I don't know. I don't feel very comfortable with telling people that RRG predicts the future. As I said, look back to the definition. We're tracking trends, we're following trends, we're trying to pick up relative trends, and that's what we do. So whether it's best for you to look at the daily or the weekly graphs, that completely depends on your investment horizon. Longer term trends, you want to look at the weekly RRG. If you're interested in shorter term trading, you may want to look at the daily RRG. So if you want to predict, I don't like the word predict, but if you're more interested in following shorter term trends, then yes, you should use the daily RRG to basically get a grip on the short term trend, which is most likely to extend into the next trading week. And then here, this one is pretty much the same as we had with, I think it was Louis, it was the first question. So again, back to the definition. The RS ratio or RRGs are trying to pick up trends, and the RS ratio is the metric that tries to pick up trends. That's our measure of relative trends, and therefore it is definitely not the same as a simple ratio calculation. We're actually trying to pick up the trends in that ratio calculation and compare it to everything else in the universe. It's the multiple against multiple, and that's why we're able to actually plot everything on one graph. We're going to look at a chart, and then I'll show Stan, how you can actually do the split windows, because a lot of people ask me that, and it's just such a simple thing. So here's the EWCO chart that Louis had in his email with the sector and RSP, and here is the ratio, and here are the RRG lines. And as I said, again, here it picks up the new uptrend, stays there, and then it picks up when it starts to weaken. And here we are dropping into the weakening quadrant. And sorry, here we are dropping. Here we are dropping into the weakening quadrant, stay in the weakening, and here we pick up a new downtrend, or the RRG algorithm signals that a new downtrend has started for EWCO. And then, as you can see in the chart here, it starts to level off and flatten, and that's when the RS momentum line starts to level off and pick up a little bit, because it's an improvement. It's not dropping further, it's going flat, and that's an improvement. And that improvement now seems to have had its best time with RS, the relative strength line dropping to new lows. And you will eventually, because it is a trend following algorithm that looks at all these things, so there is a little bit of a delay there. We're looking at a weekly RRG, so there is even more. It tries to pick up the bigger trends, and I do think that it did a pretty nice job of actually picking up this downtrend here. And remember what I said, the RS ratio is the most important one. When RS ratio is below 100, according to the RRG algorithm, the relative trend is still down. And I think that trend is still down. Actually, we just had a confirmation that it's still down. So the best way to put all of that in perspective is actually look at the RRG itself, which we have right here. This is the RRG for equal weight ETFs. And if we look at the communication services, we are right here. And it's actually the second from the left. So it's pair one, the worst sector in this universe, despite the fact that it's picking up. Now, Stanley, watch this. I can actually grab a tab here, make that a simple one chart. When I drag that to the right, can you see what's happening with that window? That's snapping to the right. So when I let that go, it snaps to the right hand side. And then I just pick the one that I want to have on the left. And that's this one here. And I can make that. And now I have two windows side by side. So this has nothing to do with RRG, has nothing to do with StockCharts. This is just a Windows thing. If you grab a window, snap it to the right, it snaps to the right and takes up half your screen. If you do the same to the left, it snaps to the left and takes up the left side of your screen. Or you can do a control right or a control left on your keyboard, and that'll have the same effect. And that gives you the opportunity to actually look at these charts side by side, and that's what I use most, because I like to have the RRG and then the individual charts, so I can go back and forth between those charts and make up my mind. I think I have covered most of these questions, so I'm going to leave it at this. You all know it. When you have any questions, any more questions, different questions, just drop me an email. At some stage, we'll most likely talk about it in the show, or I'll give you a personal answer over email. And this wraps up Sector Spotlight for this week. Thank you again for watching, and remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern, and I hope to see you again next week at a new episode of Sector Spotlight.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.